how to trade triangle chart patterns like a champ. Now, chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occur between buyers and sellers of financial instruments in liquid markets. Pattern formations do not form, and remember this, do not form a trading system. Triangles, head and shoulders, wedges, pennants, flags, they're not a trading system. They are part of a interpretation of price action. But rather they provide an indication of future trends of an asset as the price breaks key psychological barriers in the form of support and resistance lines. I am sure you've heard about chart patterns for online trading and their relation to technical analysis. Now, I know the word technical analysis is a big, scary word. Most people think, or automatically, or online traders, think of technical analysis being things like stochastics and RSI and MACD and all these complex mathematical formulas and statistical analysis. But that's not true. You could really define technical analysis as anything and everything you do with a chart. So just looking at a line chart puts you in the area of technical analysis. Technical indicators are just one small part of the field of technical analysis. Another one of those is chart patterns. So you probably know about double tops and triple tops and head and shoulders and rectangles. But in order to have a complete understanding of chart trading patterns, we should gain a good understanding of one of the most common on-chart formations. What I'm referring to as triangle trading patterns. So in this webinar, we will discuss the basic triangle formations and some ways to properly identify and trade these patterns. So let's go over to a live chart and I'll show you what a triangle looks like. I'm not going to just assume that you know what a triangle is. So on this chart, a market structure shows you all the different types of chart patterns that could be displayed during your trading session. We have bull pennants, ascending wedges, descending wedges, triple tops, bear flags, bear pennants, inverted head and shoulders, inverted cup and handle, expanding wedge, the right side up cup and handle, and a right side up head and shoulders. Okay. Now, because I told you I'm going to give you some of my 45 years of experience, I only look for CFD trading. I only pay attention to triangles. Now, there are three main types of triangles. There's symmetrical, ascending, and descending. I don't even separate them apart. And in fact, I include in what I call triangles wedges, pennants, and triangle formations. Because anytime the definition of the difference of these is the angle in which the support and resistance lines are making. Okay, if you want to memorize them all, you can. But a wedge is simply a triangle that the angles are slightly different degrees. An ascending triangle, a symmetrical triangle means the angles are at the same degree. An ascending triangle means the bottom of the triangle is moving up while the top is horizontal. Descending is just the opposite. But the fact is, I don't care. Because triangles do not give you directional clues. Some people try to put this into triangles, but they really don't. Triangles are not like head and shoulders patterns. Head and shoulders patterns give you very specific. It tells you when you're finished the shoulders pattern and it breaks the neckline, it's going to move in the opposite direction of the previous trend. We don't get that with a triangle. Okay, we have no idea which way a triangle price will break out of a triangle. So we have to have rules. But what we're looking at here could be classified as an ascending triangle. Okay. I don't care. I just care that I have a triangle formation. So keep in mind, let's not make it overly complicated. So a triangle is a specific figure formed on a price chart, typically identified when the tops and the bottoms of price action are moving towards each other like the sides of a triangle. When the upper and the lower level of the triangle interact, traders expect an eventual breakout of the triangle. So in other words, price and traders are being forced into the apex of this triangle. It's getting smaller and smaller, the range of prices. It's getting congested in there. And as such, we will get a breakout. But there is no way, using just a triangle, that you can decide whether we're going to get a breakout going up or a breakout coming down. That's why we call them breakouts. Now you can break out, it can break upward, it can break down, but it's still a breakout. So as such, many breakout traders use triangle formations to identify breakout entry points. Now there are different kinds of triangles that can be seen on a price chart. Before you jump into triangle trading, you should understand the difference between the formations. We'll take a closer look at the various triangle chart patterns and the corresponding setups, but they don't even vary. How you set it up, the trade, and how you can figure out where, when it breaks out, what direction, once it breaks in a direction, how far the target should be, what the momentum should carry, is basically the same regardless of the type of triangle. Now, once you're equipped with this knowledge, you should be able to add a triangle trading strategy to your trading arsenal. So a symmetrical triangle is a situation on a chart where the tops of the price action are lower and the bottoms are higher. So in other words, we have the bottom support line moving upward, the top resistance line moving downward, and they're moving at the same, the two lines are on the same degree. They're moving in the same angle. Now, we don't know if price is going to break out upward or price is going to break out downward. But this is called the symmetrical triangle. And like I said, I don't care. Typically with a symmetrical triangle, the expected directional breakout is unknown. The reason for this is that the bullish and the bearish move have equal strength as seen through the price action. When a breakout eventually occurs, it is likely to provoke the price move equal to the size of the pattern. And this is quite unique, but it works quite well. When we get the breakout, we can estimate the direction of the move, the length of the move, by taking the width of the pattern and then dropping that on our chart here. And we can do the exact same thing for a symmetrical, an ascending or descending, or a wedge. There are some others that have formulas that use 0.618 or 1.618, and some say that a breakout in that direction from an ascending triangle is going to be a lot farther than that, but it's hogwash. Because we're only setting a projected point to set our target for our move. We still have to see what the momentum is. So let's go back and look at my chart here. So in other words, the width of this triangle right here come on. We could take that, and if it breaks downward, that would be our estimated move of the downward move. And if it breaks out upward, that would be the directional move there. Because that is the width of the overall, the width of the triangle formation. But that's only an estimate for where we would expect the momentum to carry it once we get a breakout. So before we talk about how we would calculate this breakout, let's go back and quickly talk about the other types of triangles. So as you see from the example, the potential target is based on the size of the triangle formation. With this type of measured move analysis, you will know what to expect from the symmetrical triangle breakout, whether it breaks upward or downward. Then we go on to ascending and descending triangles. And as I mentioned, just simply, here we have the upward sloping resistance line, support line, and the resistance line is horizontal. And it's just the opposite in a descending triangle. Now, normally we get an ascending triangle in the middle of an uptrend. We get a descending triangle in the middle of a downtrend. But that is not a steadfast rule or law, because you can have areas in an uptrend that the price is easing and it can form a descending triangle. But that's a generally accepted principle, but it doesn't make a difference for our trading. Because as price is forced into this apex, we don't know if the breakouts can be up or down. Now, a lot of trend traders hope that if this is coming off of an uptrend and it breaks out, it will break out and continue its uptrend motion. But a lot of traders, a lot of times you see the reversal. So until we get the breakout, we're not sure anyway. So why start predicting what's going to happen? So give me 1 second here. So let's see if I can do this correctly, and I have a little demonstration for you. I had recorded a little demonstration, but I showed it to you on the charts anyway. It doesn't seem to be working on my chart. So here we have the ascending and descending triangle. The rules are the same. Everything happens exactly the same. You have an uptrending in an ascending triangle. The bottom support line is ascending upward, and the resistance line is flat. And a descending triangle is the exact opposite. And you can still measure the width of the triangle. So it's very important to mention that the ascending and descending triangles sometimes break through the incline level and cause false signals and trap some traders in the wrong way. You should always try to wait for the close of the candle to confirm the breakout. This will reduce many of the false signals. Now, pennants on the chart have a similar shape to that of a symmetrical triangle. And I don't differentiate between, like I mentioned earlier, between triangles and pennants. Because again, I am only getting something that's going to tell me that I'm expecting a breakout and give me the formulas for calculating it. I don't really care what you call the time. And I'm not going to waste my time. And that's where people get traded. Oh, well, that's a pennant. So I'm going to apply this formula and that and that and that. Doesn't help you. Now, they typically appear during trends and have a trend continuation character. Because I'm going to show you, we've done a statistical study checking 525 triangles to see how often this character was right. If we had an ascending triangle, would the breakout be up? And a descending triangle, would the breakout be down based on trends? Would a symmetrical triangle, well, a pennant give you a trend continuation character. We found out no. If you simply traded the character or the preference or what people told you about the triangle, you'll find out, and I'll show you in a minute, you only have a 52% success rate. You need a lot more than that. So a bullish pennant is similar to a symmetrical triangle in appearance, but the bullish pennant formation comes after price increases. Since pennants have trend continuation characters, the bullish pennant is likely to continue the bullish trend on the chart. 52% to 48%. That's not enough to make any conclusion as far as I'm concerned. When the upper side of the pennant gets broken upward, we are likely to see an increase equal to at least the size of the pennant, or typically larger. Again, we typically see the width of the pennant. So this is where I had mentioned to you before. There's some weird people out there saying this is the calculation. You can use a 618 side of the leg and you have two targets. Okay, I don't pay any attention. What we're looking for is a successful way to trade. Okay, I'm only calculating my target for my risk management, for where I'm going to put maybe my limit order or my take profit order. Okay, if price surges up there, I don't really care. I'll take all the money I can take. But for my calculations, I want to be conservative anyway. I want to trade here. So like I said, there's all kinds of stuff out there that doesn't really help us. So see here, we have two targets. The red target is the first one, which is as big as the size of the pennant. The green target corresponds with the size of the previous up move, which should be applied starting from the upper side of the pennant. Well, then we're getting into Fibonacci's. We're not getting into, we're estimating, oh, well, we have this jump up, so it should be the same. We're talking about other stuff far out in left field, okay, or other types of strategies. Bearish pennants, we have the exact opposite. So think of them as ascending and descending triangles. They have the same rules. So here on my chart, you can see the several of all of the triangle patterns. Okay, so like I said, some have bullish or bearish tendencies. We don't rely on them. We look for a symmetrical triangle. We look for rising wedges. We look for symmetrical bearish wedges. We look for expanding. We don't care, because we're not going to make our calculation and we're not going to make our decision just on the triangle alone, because this is where you get hurt. Because let's go over to my chart. Because based on all that we just read and learned, we would have been taking this as a breakout, and we would have, at the end of this candle, with this green candle, we would have been buying this asset to go long. We would have predicted the move to here, and we would have lost our shirt. So this is why we don't rely on triangles alone. We have to have rules that apply. Now, because this move is a sizable move, either way, okay, it's a sizable move. Do we need to catch it at that one point? No, if it's going to have the momentum and the breakout's going to be confirmed, and it's going to carry it that far or this far, I got ample time to make my decision to jump in the markets. Because I don't want to jump in after this candle. This is what the rules on triangles tell you to do, if you're reading all the literature on triangles. Okay. So my first rule with triangles is triangles are very, very reliable if you combine them with your other decision-making capabilities. The first one of this is not the close of the current candle at the breakout. I wait for 3 candles. I will make my trade at the 3rd candle. And I don't care if the candle is bullish or bearish. Okay. So here in this case, the 3rd candle was a bullish candle, but I would have been trading this direction. Why? Because we got the breakout here. The breakout closed below the triangle. We waited for the 3rd candlestick to make sure it didn't bounce back in. Here we had 1, 2, 3. This is where you might have considered making your bullish buy, but look at this. We move right back in. So we had our breakout candle. I'm sorry, this is the 1st candle, 2nd candle, 3rd candle. There was nothing to substantiate that momentum because, things can break out. Here we had our breakout candle, then 1, 2, 3. The other thing we want to see is we want to see a change in volume. Here, we had no change in volume. Change in volume means the traders are coming back into the market, and because it's the traders that have to push this momentum. They're the ones who have to create the momentum to push the price down to here. If the price is going to come all the way down to here, the fact that I got in here instead of here didn't bother me. Because guess what? I wiped out all those false signals only to get good signals. So let's go back to my PowerPoint for a second. Okay. So we're going to take a look at the candlestick in the New Zealand dollar and a 15-minute chart. Now, the question is, how can we trade symmetrical triangles? And forget the word symmetrical. It's how can we trade triangles? Okay. Since bias upon the conclusion of a pattern pointed higher, we look at the opportunity to buy the pair. So in other words, we got the breakout here. We're looking for the opportunity to buy. 1, 2, 3 candles. We would have bought at this level. We could have set our profit point at this level, and we would place our stop loss at the lowest low of the candle in that wedge at the breakout point. And whether it's a symmetrical, ascending, a descending, same rules. So we place our stop loss slightly below the most recent significant low. The pair continued to consolidate prior to the rallying approximately 80 pips. Considering this on a 15-minute chart, the profit and risk are generally smaller than the pattern appeared on a larger time frame. Now, remember, what we're trying to do is we haven't even put this through our risk management filter. So our wedge here is what we would then apply here so that we can then, our estimated point of stop loss and our entry point is how we would then calculate our risk reward ratio to see if we can fit this into our risk management rules. So once the triangle is identified in the chart, traders will wait for the breakout either above the resistance trend line or below support. After the breakout is confirmed with either a closed candle above or below support, a stop is placed approximately 10 pips below the last swing low of the triangle. A limit equal to the height of the triangle is then placed. Okay? So again, we see here, width of the triangle, drop down here. Here's where we place our limit order. Here's our breakout. Here's our entry, 3rd candle. Stop loss is placed 10 pips below the significant swing low, not the close of the candle, but the significant swing low. Okay. If you follow all these steps, you find that a lot of times you're going to be correct. More than enough to generate enough profit from your losses and your profit. So if you notice, here we have an ascending triangle. Same thing is done. We don't change the rules for the type of triangle. Again, limit order, breakout, stop loss, entry point. Descending triangle, same thing. It's just the flip over, it's just reverse of the ascending, and it's the same rules for a symmetrical. Breakout, 1, 2, 3 candles, entry point. The width of our point, and that should establish our limit. Our stop loss is 10 pips below, in this case, the swing high, because we were in a downtrend and we broke out going down. Now, remember I mentioned earlier how reliable candles were, or how reliable triangles were? Well, to get an idea of a pattern's reliability, I've analyzed the charts of 5 currency pairs over a 10-year period. On the 4-hour chart, there were 165 symmetrical triangles. I measured the trend using the slope of the simple moving average line. If the breakout after the triangle was up and the trend was up, this was classified as correct bullish. When the breakout was down and the trend was down, this was classified as a correct bearish. Patterns where there wasn't any clear trend we've ignored. Well, look at the results. Okay. The average correct bearish was 54% and correct bullish was 54%. This was just simply using whether it's an ascending triangle coming from an uptrend or a descending triangle coming from a downtrend. Well, I'm not going to trade anything. It's only giving me a 54% edge in the right direction. And as the table shows, on the H4 charts, the symmetrical triangle has a favorable history of success. The odds are about 54%. Then when we go down to a 1-hour chart, we even get a little bit less. We go down to about 52% success. Okay. That's just assuming that if we had an ascending triangle off of an uptrend, it would be an overall bearish character and we would be looking for to buy. Okay. So in this test, there was a total of 525 patterns on all charts over the period investigated. The pattern was correct in predicting the continuation of just 52%. Even though the numbers are quite small, this does give some objective data on the reliability of symmetrical triangles across Forex pairs. But by moving the odds in our favor, we found when you use an increase in volume and a third candle, you move up to an overall 78% correct ratio. So when the pattern ends and the volatility dips to a minimum and the support and resistance lines are very close, the market will then usually start to show some preferred direction. But there's no guarantee. So if you throw out the directional bias and then use the rules, you'll find that you've moved the odds in your favor. The easiest way to trade this chart pattern is to treat it as a continuation breakout. Okay. While there are instances when symmetrical triangles mark important trend reversals, they are often a mark of continuation of the current trend. Regardless of the nature of the pattern, continuation reverse, the direction of the next major move can only be determined after a valid breakout. Then we want at least 2 points to require the form of the trend line, and 2 trend lines are required to form a symmetrical triangle. So in other words, you could see lots of small triangles that don't have a real, just because you can connect a support line and a resistance line, or to call them trend lines, and put them together to form a triangle, doesn't really mean you have a valid triangle. Price can be erratic all over the inside of that. So you're really not having this triangle formation. You can just, because you just drop lines. So the more times that prices touch the upper or the lower line as it's moving in that channel, and the less erratic price is, the more reliable the signal is. Then, of course, and I keep mentioning, we want to watch volume. As a symmetrical triangle extends and the trading range contracts, volume should start to diminish. This refers to the quiet before the storm, or this tightening consolidation before the breakout. Once we get a verifiable breakout, third candle, you should see volume increase. Now, the longer the triangle has taken to form, also the more reliable it is. So remember, the future direction of the breakout can only be determined after the break has occurred. Sounds obvious enough, but attempting to guess the direction of the breakout can be very dangerous. Even though a continuation pattern is supposed to break out in the direction of the long-term trend, this is not always the case. A break should be on the closing basis of it to be considered valid. Some traders apply a 3% break or time-sustained break. Okay. Breakouts should occur with an expansion of volume, especially on an upside break. After the breakout, the apex can turn into the future support and resistance. There are 2 methods for estimating the extent of the move after the breakout. First, and this is the one we use most often, this is the one we've been talking about tonight, the widest distance of the symmetrical of the triangle can be measured and applied to the breakout. Second, a trend line can be drawn parallel to the pattern's trend line that slopes up or down depending on the break, and the extension of that line can mark the potential breakout target. In sum, triangle patterns are easy to spot and provide good risk-reward opportunities. Traders can quickly know that a big move may be near, and as well as the profit objectives and the amount to put at risk. Now that you have the knowledge of the 3 powerful price patterns, you are a step closer to becoming a more confident trader. So that's it on triangles. They're not complicated. You can add them into your strategies at all. I use a combination of my triangle, my third candle, my volume increase to support my decision making, to give me my point, but I also use, and always looking for how well defined the pattern is. And then lastly, I also look at my overall support and resistance lines to help me understand where that pattern or where the breakout has occurred, and where I should see stepping stones towards that target that will confirm that distance of the move. So thank you very much for joining us tonight.